Hello dear traders, last week was relatively uneventful, yet all three key USD indices managed to close the session in the green. A mix of ongoing factors, a shorter trading week and expectations of a softer monetary policy contributed to this outcome. The fresh trading week started on a neutral note, although futures were mostly titling towards the negative territory. By the end of the week, the market may see some significant shifts. Investors are currently digesting the fresh macroeconomic data, including new home sales, the latest manufacturing insights from the Dallas Fed, consumer confidence numbers, and inflation updates. Also drawing attention are several bond auctions and remarks from Federal Reserve officials. On the corporate earnings front, such big players as HP, Salesforce, and Dell will report on their performance. Stay tuned, the world of finance is full of unexpected developments. Watch this video till the end and leave your comments below. This week on Wall Street, the US stock indices made a slight pullback on Monday after a 4-week winning streak, with the major averages dipping by roughly 0.2%. It seems traders are playing it safe ahead of major economic announcements, including the Fed's preferred inflation work, the PCE. The energy and the industrial sectors showed the worst results. In the corporate arena, Tesla shares dipped nearly 1%, while Nvidia is trying to bounce back from Friday's slump of 1.9%. The broader growth on Wall Street is largely driven by investor optimism that the Fed might pause its rate hikes and possibly cut rates next year despite mixed economic indicators. Last week, preliminary data showed a sharper than expected downturn in the manufacturing sector, contrasted by a quicker rise in the services sector. Jobless claims dropped more than predicted, while durable goods prices fell unexpectedly. Inflation expectations for the next year, as per the University of Michigan, have risen for the second month in a row. Importantly, the indices are still hovering near the yearly highs, just a few points away from their absolute peaks. The endless rally in November may soon start to fade away. Interestingly, the indices jumped by 10% this month, marking the fastest rebound after a correction since the 1970s. However, it seems that the major gains for 2023 have already been made, and replicating November's success in December might be challenging. In the coming weeks, the indices could still reach their formal highs. For the S&P, this is just above the 4,600 mark. Over the past week, the S&P has risen by 1%. The coming year is set to be a decisive one for the index. The path to the end of the year is expected to be anything but smooth. A moderate recession is anticipated mid-year, along with sell-offs of the credit market in the second quarter and continued quantitative tightening. The target for the end of 2024 remains unchanged at around 4,750. As for the current situation, the 4,560 level continues to be a stubborn resistance for the index, holding strong for several sessions. Meanwhile, the Dow Jones saw a 1.27% increase last week. While this is a notable growth, the upcoming economic releases could significantly sway market sentiment. On Thursday, all eyes will be on the upcoming October PCE index data, a critical inflation indicator closely monitored by the Fed. The market is poised for a potentially volatile reaction, with investors seeking signs of inflation deceleration. Any deviation from the consensus reading could trigger a market sell-off. A decrease in inflation might hint at the possibility of the Fed delaying rate cuts to the next calendar year. Currently, the market expects the first rate cut to occur at the May meeting in 2024. As of the week's start, which could change closer to the release, the core PCE index on a monthly basis is expected to decrease to 0.2% from 0.3%. The annual figure for the core PCE index is projected to drop to 3.5% from 3.7%. The consumer price index, which includes food and energy prices, is expected to decrease from 0.4% in the previous month to 0.1% in October. Year over year, the consumer price index is estimated to drop to 3% from 3.4% last month. However, the core CPI is considered to be more significant for central bank officials. Last week, the Nasdaq saw a modest increase of 0.89%, hinting at the tip of the iceberg in the market dynamics. The burning question remains: should we expect the rally to continue? To answer this question, let's revisit the topic of inflation. It's noteworthy that markets are gradually shifting their focus away from inflation concerns. However, Jerome Powell, the Federal Reserve Chairman, does not seem to share this sentiment. His speech on this Friday could not only summarize this week's events, but also potentially throw the market off balance. Powell's address might be the last before the Federal Open Market Committee's December meeting, as we enter a period of relative calm. Powell is likely to remind the market that inflation remains a serious concern for the Fed and reaffirm their readiness to implement further policy tightening if necessary. This stance comes despite an observed improvement in financial conditions since the Fed's November meeting. The Goldman Sachs Financial Conditions Index, for instance, has effectively neutralized the gains since in September. The past 22 days have witnessed a significant easing in financial conditions, mirroring the relief typically associated with rate cuts in 2008 and 2020. However, 2022 has seen similar patterns of financial easing, notably in August, November, and January 2023, each followed by a stock market rally. These rallies, however, have often been short-lived. Subsequently, they were followed by tightening of financial conditions, and the stock markets lost most, if not all, of their gain positions, as seen in September 2022, December 2022, and February 2023. This historical pattern suggests that the recent rally in November 2023 might also face a potential correction. Jerome Powell is not in favor of rapid easing of financial conditions that could stimulate the economy and crucially fuel inflation. According to Goldman Sachs, a key observation is the drying up of systemic flows, indicating a potential shift from stock buying to selling. This trend suggests that the recent rally from October's lows is not just built on shaky ground. The very structure of this growth is fragile. Apparently, the rally has been driven not by improved fundamental outlooks, but by capital flows and market positioning. This pattern mirrors the previous rallies seen in August and November 2022 and January and July 2023. Historically, following such surges as observed in September and December 2022, February 2023, and between August and October 2023, the market has typically lost nearly all its gains. However, the current scenario may unfold differently. The looming risk of a recession remains the market's primary concern, though it appears unlikely in the near term. For now, there seems to be no impediment to the continuation of the sound rally. Market pullbacks are to be expected, especially after the steep rise witnessed in November. We continue to monitor the situation to keep you informed of all developments. Don't forget to subscribe to our channel and comment on the videos. We work for you, bringing the most relevant updates every day and every week. That is all for now. See you soon.